put in context what we heard from the Fed last night there, and they remain unmoved despite criticism from the president, despite market turmoil. They stick to the gradual rate hike path. I'm guessing you weren't surprised.
No, and in a sense it's reassuring to see a central bank which is in this environment remain independent, both from a market perspective as well from a political perspective. We don't see that everywhere in the world. We do think that the situation in the US economy clearly warrants a tighter monetary policy, and the Fed will soon be followed by many other central banks. We see, by the way, also in EM a lot of central banks which are now tightening or on hold. So the easy monetary environment is definitely over, and 2019 will definitely be an inflection point from that perspective.
Okay, so that's interesting. So, I mean, reassuring, you describe it as not risk on, though, for assets. It's been seen as a bit of a risk off, the fact that the Fed is going to, keep hiking. The Fed put, if we thought it was close by, seems to be a little more distant. Yeah,
we have not reached yet the pain level, I would say, for risk asset. We remain convinced that we need to be in risk asset, to need to offset part of this risk with a bit more hedges in portfolio. So it's definitely not the time to be full risk on, but also not the time to give up on equities and on risk assets, generally speaking. So there are a lot of reassuring items. The earnings season in the US, like elsewhere, even in Europe, was pretty good. Obviously much better in the US than in Europe, but Europe have shown some reassuring sign also on the banking sector, which was a theme in the US as well. But it's true, November, there are still a lot of risk. We have now a bit more clarity on the political front in the US, but we still have many uncertainties in Europe, Brexit, Italian budget, the G20 at the end of the month. These are the elements which are probably more concerning today than the simple fact that monetary policy is normalized in the US.
So divergence in interest rate policy, you think that's a 2017-2018 story, and we leave it behind next year then, Vincent. So what does that mean for US assets? Does it mean you actually want to be away from those and actually more exposed to emerging markets or other parts of the world where we might see more hikes?
Not yet. We will need to see the effect on the dollar, obviously. We've seen the dollar strengthening again. As long as we keep seeing the dollar strengthening, this will remain obviously a negative element for emerging market. On top, obviously, the ongoing trade talks or trade war, which is hurting emerging market assets, generally speaking, hurting emerging market economies. We see that exports are definitely slowing and off their peak since the beginning of the year. We had the Taiwan export yesterday again, which show a drop. We see that Chinese currency reserves are decreasing. So there are a lot of worrying signs in emerging market at the moment due to the strength of the dollar, due to rising rate in the US, and due to the trade policy of the US government. But it's the US policy, but it's our problem, I want to say. It's a bit like the dollar in the past. The US economy and market is better insulated against those risks, and I don't think that we have reached yet a level of interest rate which will hurt company profit. This set, we see many more headwinds in 2019 than what we had in 2018. Or average hourly earnings have risen above 3%. This will hurt margin. Financial conditions are unlikely to remain as easy as they are today. So definitely, in terms of our earnings expectation, they are lower for next year than for this year.
So yeah, average earnings 3.1%. And I was looking at the JOLTS report, the sort of quit rate in the United States, and one analyst at Schwab, I think it was, suggesting that this bodes positively, if you can use that word, for average earnings, that it'll go up to 4% on the back of the rate of quits that we're seeing in the US economy. That's going to be quite punchy, isn't it? And as far as wages are concerned, is that worrying? Does that suggest the Fed is behind the curve, or is the Fed going too fast and in danger of tightening too much, do you think?
I have the impression that the Fed is doing what it should do, obviously, given the circumstances. We haven't seen any build-up in inflation sizable at this stage. It is true that wages are now above 3% in terms of growth. We will see whether we get this 4%, which would be normal given the economic circumstances, but it has taken time to get already to this 3%. So we will see. I would say the outcome of the midterms election make this case probably less likely than it would have been with a full Republican leadership in the US. A tax cut 2.0 is unlikely for next year. So adding much more stimulus to the US economy is less likely than before, meaning that there's also less odds of having a massive surge of wages next year.